Company reported the best quarter in history and still lose billions in a market value in single day. That's exactly what happened to SK Hynix. The answer is it missed expectations. But after reading the entire earnings call, I don't think that's the real story because I think the market is focused on the wrong risk. Let's be precise about the miss. Analysts were not just expecting a good quarter, they were expecting a perfect one. Consensus was around 84 trillion won in revenue and around 64 trillion won in operating profit. SK Hynix delivered 79.3 and 60.5. So both came in roughly 6% lighter, a record quarter that still missed. But here is the context that matters. This stock has already fallen almost 50% from its June peak before earnings even dropped, and it reported into an ugly day for the whole sector. China's CXMT memory IPO, fresh doubt about AI spending, a sell-off hitting Micron, Samsung, everything. So this was not a clean verdict on the quarter. The bar was impossibly high and the tape was already broken. If you saw the headlines, you saw the net profit of 93.9 trillion won. That net profit overstates the underlying quarter because roughly 63 trillion won came from investment gains. For the actual memory business, focus on operating profit of 60.5 trillion won, and that is the cleaner number and the one that missed consensus. What actually went wrong? On the surface, pricing looks spectacular. DRAM selling prices up around 13% quarter over quarter, NAND up more than 50%. Those are not the numbers of a struggling industry, but on the call, an analyst pushed on something specific. DRAM pricing coming in below what the market expected, and the management's answer was the tail. Some of their highest value products, meaning the HBM, the crown jewel, had shipment pushed from this quarter into the second half. That shift in mix dragged their blended selling price. So sit with what that means. The disappointment was not weak demand, it was timing and mix. The premium volume slipped to later in the year. That's fixable if the second half SBM4 ramp up actually delivers. But it also a real question mark, which brings us to the bears. They have four legitimate concerns. First, growth is decelerating. Next quarter, DRAM shipments are guided up about 10%. NAND just low single digits. Still the growth, but slower. And in cyclical industry, the market watches the direction, not the level. Second, the capex. SK Hynix just guided 2026 capital spending to the high 40 trillion won. Its largest ever. Remember the classic memory cycle. Demand rises, prices surge, everyone overbuilds, and then prices collapse. SK Hynix itself is now doing the building. Third, China, and here is the sharp version of the risk. China does not need to beat SK Hynix in SBM tomorrow. If Chinese makers just get competitive and standard DRAM and NAND, they flood that commodity segment and push those prices down, and that commodity memory is the wide profitable base of the business. So SK Hynix earnings get squeezed into a narrower and narrower slice. The advanced AI memory, mainly HBM, that means more of the company's fate riding on one product line for a handful of customers. That's not more profit, that's more concentration risk. And in other words, the moat has to keep moving forward. Standing still is losing. And then fourth, the long-term agreement LTA. The company signed multi-year deals with around 10 major customers. Customers lock in supply because they are terrified of being left without memory when AI demand surges. That's great, but there is a catch the bulls skip. By selling those seats at a fixed price, SK Hynix also give up the chance to charge more if demand explodes. Stability in exchange for a peak cycle upside. It's a trade-off, not a free win. So why do I still lean positive? Because the line from the top, this earnings call was not really about the SK Hynix earned last quarter. It was about whether AI has moved from a chip story to a memory story. And the evidence for that shift is everywhere in this earnings call. As AI moves from training to inference, the demand stops being just about the GPU and starts being about feeding the GPU. HBM is not just another memory chip, it's becoming the premium engine inside every high-end AI server. But what was happening underneath it? Enterprise SSD revenue doubled quarter over quarter. And the solar DRAM high capacity drives more than tripled. Server DRAM demand is climbing to support agent-based AI. Management said customers are still asking for more supply than they can deliver. That's the whole thesis. HBM, server DRAM, and enterprise SSD all rising together. Chip story to memory story, and two things back it up. Those LTA deals include upfront customer deposit. You don't wire cash early for a business you think is about to collapse. And the balance sheet is a fortress. Net cash around 69 trillion won. Debt to equity down 7%. On top of that, SK Hynix just listed on the Nasdaq, the largest ever US IPO by a foreign company. And management said additional shareholder returns are under review this year. That's a catalyst sitting in plain sight. So here is where I land. The market repriced us a record quarter for reasons that are half about the SK Hynix and half about the China Micro and a stock that had already run too hard. The operating business is not broken. The demand is real. The miss looks like timing. But I don't trust a thesis I can't kill. So here are the 3 invalidation points I am watching. 1. If next quarter's blended DRAM pricing goes flat or negative, then it's just mix and timing story falls apart. 2. If the second half SBM4 ramp slips again, the pushed out volume becomes a pattern, not a quarter. 3. If 2027 SBM pricing negotiation come in below current levels, the pricing power story is cracking. If any of those happen, I am wrong and I will show right here. If none of them do, this sell-off was a gift. That's my analysis. Now I would like to know your view. Do you think the market overreacted or the risk justified? Share your thoughts in the comments. If you found this analysis useful, subscribe for more research-driven stock market content. This video is for educational purposes only and should not be considered financial advice.